welcome again to this last panel of the EIF. We have discussed a very broad range of issues, from geopolitics to artificial intelligence to healthcare data. We finish on the economic outlook, which of course is an issue of general concern for all of us and for all citizens in Europe. I will not bore you with any long introduction on the topic. Maybe I will limit myself to observing that the question mark in the title of this panel seems rather justified, a road to recovery question mark, because we seem to have entered a rather volatile and uncertain economic environment. This was already reflected, I think, in the summer forecast of the Commission published about a month ago, which detected a dampened growth momentum in Europe for this year and next year, and also an inflation that has dropped significantly from the height of last year or so. October last year, I think, was the peak, but remains significantly higher than the 2% medium-term goal of the European Central Bank. So that is compounded by a very, to put it mildly, a very unstable geopolitical context, with ongoing war in Ukraine and now this new conflict in the Middle East between Israel and Hamas that we all hope remains circumscribed, but it might escalate. And this will have, of course, a bearing also on the economic outlook for next year. Maybe last sort of background aspect that I would mention is the fact that the sort of economic constitution of Europe is in the process of being rediscussed in many aspects. I mean, the Stability and Growth Pact, so the fiscal framework, we are in the process of renegotiating it, and if we don't agree on a new set of rules, the old rules will kick in, back in from next year. The ECB monetary policy has changed quite significantly in the last year or so. So a whole set of very complex, risks and issues, and we have four amazing speakers to discuss all aspects of the problem with us. I introduce them now in alphabetical order. So I start from Oscar Arce. Welcome. You are Director General for Economic Statistics and Research at the European Central Bank. You have had a number of other positions, which I will not list now for the sake of time, but a very rich biography and the top monetary policy maker. We have Maria Demertzis, who is Senior Fellow at Bruegel and part-time Professor of Economic Policy at the School of Transnational Governance of the European University Institute. You have also been Deputy Director of Bruegel until last year, I believe. We have Martin Larch, who is Head of the Secretariat of the European Fiscal Board, so an independent advisory board within the European Commission focused on fiscal issues. And we have, last but not least, Siegfried Muresan, a longtime friend of the Martin Center, I would say, to begin with, but more importantly for the purpose of this panel, Vice President of the EPP, member of the Committee on Economic and Monetary Affairs of the European Parliament, and also General Rapporteur for the EU budget for 2024 in the Parliament's Budgets Committee. So I suggest that we start delving into the issue, maybe starting from the more seemingly technical, technocratic topic, which is monetary policy, and ending on the more political issues. And maybe I will start by asking Oscar a question. I mean, we are, as I mentioned, I mean, the inflation rate is still significantly higher than the medium-term goal of the ECB monetary policy. We have experienced a significant tightening of monetary policy over the last half year or so. What is the strategy to make sure that this doesn't dampen excessively economic activity going forward, also in an election year such as 2024?
Well, thank you, Federico, and thanks to EIF for inviting me to this fascinating panel. So your question is a tricky one, no? As you said in your introduction, inflation is going down. We are now less than half of the level that we had just 1 year ago. And this is the result of the combination of two factors, I would say. No? One is the fading out of previous negative supply effects, mainly on energy cost, but also on food, which is still pretty high in terms of inflation, but it's going down. Also the bottlenecks and so on that were affecting negatively supply chains are kind of already almost normalized. And the other important factor, of course, is monetary policy, which has tightened significantly. I would say not just over the last year or so, but I would emphasize that we started the normalization of our monetary policy already at the end of 2021, when we announced that the pandemic programs and more generally the loose monetary policy stance at that point would be normalized over the course of 2022. No? Something that we did. In particular, with the latest decision in the Governing Council in September, 3 weeks ago, the ECB has increased the policy rates by 450 basis points and is in the process of reducing the size of its balance sheet. So monetary policy is acting there. In our latest forecast, which came a little bit after the one of the Commission that you mentioned before, we foresee the convergence of inflation towards levels close to 2% towards 2025. So this is our baseline projection. And going back to your question, can we make sure that this disinflationary path that we have seen so far and that we project, we foresee to happen in the coming 2 years, can unfold without causing a very high cost on the economy? Well, let me provide an answer on this question by focusing also on our projection for GDP growth. As you said, I mean, what we are detecting right now, very much in line with the Commission, the IMF and others, is that the euro area economy is slowing down in the second half of this year. So we foresee very weak activity, very weak growth in the rest for the second half of this year. We cannot rule out even the possibility that we can see some drop in activity at some point. Later on in 24, we should see some recovery in growth rates as a combination of 2 factors, lower inflation and higher wage growth, which should allow for some recovery of real income, hence allowing some recovery of consumption and activity. So in our baseline scenario, we don't foresee a protracted or deep recession. This should be clear. Of course, risks are on the downside. The situation on the geopolitical front is very fluid, as we know today, and we cannot rule out some more negative shocks down the road. But in principle, I mean, this disinflationary path should be consistent with some growth coming back in 2024 and 2025. And all this is taking place in a situation which is pretty unusual if you look at previous monetary policy tightening periods, in which the labor market remains pretty strong. And the unemployment rate in the euro area is 6.4% in August, which is the historical low. Of course, this does not guarantee that employment will remain strong in all possible circumstances in the future, but it's something quite significant so far. No? So I think monetary policy is doing its job. The determination of the ECB is absolutely intact. We know we have to deliver on our unique mandate, which is to deliver the 2% over the medium term in a timely manner. And we will do so. And of course, this comes with a cost in terms of activity, because an important channel through which monetary policy moderates inflation is by dampening demand. And this means lower activity levels. We are aware of that. But an important service, maybe the most important service that the monetary policy of the ECB has provided to the ultimate goal of price stability is by keeping inflation expectations anchored. And if we look at all the indicators about medium-term inflation expectations, all of them are well anchored, are stable at levels very close to 2%. No? So as long as we are able to keep these expectations well anchored, as long as we are able to keep the credibility of the public on our determination to deliver price stability, the cost of this inflation will be lower. No? And I think this is an important asset for the ECB, the credibility by the public, which of course requires not only words, but also actions, no? Of the kind of those seen over the last 2 years.
Of course. Thanks, Oscar, for sort of introducing the monetary policy side of things. Of course, I mean, monetary policy tightening also has a bearing on the fiscal side and the costs of financing debt, for example. And so that's why I would now move briefly to the fiscal side by asking Martin. I mean, I mentioned we are in the process of renegotiating the entire Stability and Growth Pact. We do not know yet if an agreement will be reached and what agreement might be reached, because there are traditionally important divisions between member states. Maybe I would ask you, could you give us an update on the state of play on the negotiations on the fiscal framework, and also what risks and opportunities do you see at work here? I mean, you're from Südtirol, so you have the Italian side, but also a kind of German exposure. And so give us an overview of this.
Well, thank you, Federico. Thanks for having me in this very nice panel. Now, your question covers a number of very difficult, I would say, issues. Let me start with where we stand with the negotiations on the Stability and Growth Pact. And in order for, I think, the audience to understand where we are, I think it's important to take a step back and to look at where the negotiations started. They started at the beginning of 2020, so shortly before the pandemic broke out. And at the time, the exercise was not aimed to end with a major legislative reform of the Stability and Growth Pact. Although debt levels were already high in some countries already at the time, and that you can read in all the official documents, it was meant as a review exercise that is actually mandated by the so-called 2 and 6 pact, so the last two reforms of the pact. And if you look at the Commission document that summarizes the assessment of how the 2 and 6 pact work, you will see that it says, well, there's a number of important strengths and there are some possible improvements. Now, or then in fast forward at the end of 2022, or at the end of 2022, first with the Commission orientations, and then in spring this year with a concrete legislative reform, the narrative has completely changed. The narrative now is that we need legislative reform. Now, what has happened in between is, of course, the pandemic that has, in some countries, or most countries, increased the debt levels further. We had then energy price hikes and all its implications that were just described. But what is possibly less visible, but still very important to understand the current situation in the negotiations, is the division of the member states. So the division in the Council, you alluded to this. So there is a group of countries for which the rules, the current rules, have worked reasonably well, in the sense that public debt has acted as a buffer. So it has increased when a major crisis hit, and then it was brought down in the subsequent years. We have seen this particularly well after the global financial crisis of 2008. We saw that in most countries the debt levels went up to absorb the shock, and then they came down almost to the levels that were recorded before the global financial crisis. And then we had another group of countries where debt levels have constantly increased, and then gave rise to concerns that are still valid, especially these days. We have observed that. So I think, just to close on the point on the update, the division of the member states in terms of whether they followed, let's say, the prescribed path of fiscal policy that is embedded in the current rules or not, is still very much there. Now the Spanish presidency is working very hard to find as they call it, a common landing zone. And the official target date is at the end of the year. Why at the end of the year? Because then beginning next year we will have the European election, and then the legislative process will come to a sort of a natural institutional break. So that's why there is this official target date of the end of the year. Now, I hope that an agreement is reached, but in the debate you still have very much, if you want to simplify, two blocks, where one block says, well, you know, there is a sense now after COVID, after the energy crisis, and with new policy priorities like defense, green transition, there is a need to rethink the rules, but we also need to have assurance on, say, that also then reformed rules are followed. So this is essentially the division that we still have, that we had when the debate started, and that we still have right now. As I said, personally, I hope that this is resolved by the end of the year. Now, why is that important in the context of the economic recovery? Well, first of all, we know that the economy now is weakening, has weakened. Although personally, I think that this was to be expected. Actually, I'm positively surprised about the resilience of our economies in the wake of the terms of trade shock, the energy price hike that we have observed last year. We in the European Fiscal Board, we have done a historical comparison going back to the 70s when we had the first big oil shocks. And if you look at just the numbers, the terms of trade shock, the size that we have observed last year was much bigger than we had in the 70s. So just taking that into account, you expect that one had to expect a major impact. Of course, there was an overlap with the rebound from COVID and so on. So one would expect a sort of a deceleration in the wake of such a shock. Now, why is it relevant? Why is it important then for the outlook? I mean, if the economy is weakening, then of course this has an implication of how markets perceive sovereign debt levels. We have seen that last week markets can be quite nervous. Maybe it's not warranted, but that is a reality. Then should we see a further weakening, it's always important for fiscal policy to have enough fiscal space. That's the case in several or most member states, but not in all. So to conclude on this, I think having an agreement on fiscal rules, whether they are reformed or whether they are the old rules, I think is very important to give clarity to markets, also clarity to fiscal policymakers.
Thank you. I guess everybody will concur with that, and we will come back to some of these issues, for example, the issue of the fiscal stance later on. But I would now move briefly to Maria. Maria, you are a top think tanker, scholar with a background on central banking. So I would ask you, I mean, give us an overview of what are the key areas of vulnerabilities that you see within the next year or so, let's say until the time when the next commission will take office, and what are the key priorities and the key actions that European policymakers should take, in your opinion, to improve the outlook?
Yeah, thank you, Federico. Not a small question, a big question. Perhaps I should say it's very difficult to disentangle the short run, the next 6 months after the elections, to much more structural risks. But if I were to make that attempt, I mean, I would like to start with still the energy shock. I don't think we're quite out of the woods, simply because, well, there's ongoing wars, there is new areas of conflicts that are happening there that could possibly, not yet, but they could possibly have an effect on prices of oil, particularly. We've heard yesterday also the Finnish incident on sabotaging pipelines. All of these things provide jitters to the markets, and it's be absolutely essential to monitor what it means for energy and particularly the energy security of the EU. I don't think we should move away from the fact that our energy security still is quite precarious. It's not something that we have sorted out. We are walking in the right direction, but it is very far from resolved. So I think that would be the first one, and if you like, this is also the most urgent one, because we have a winter coming up. We need to make sure that the energy security is indeed secured. Now, I need to, I'm very interested to hear the answers to the poll question that you gave, but no doubt I think inflation is going to be up there, in particularly because it is really the heightened prices that we see are on goods that actually all consumers face every day. Anecdotal evidence will show you that food price inflation, coming down to perceptions, is so important for understanding the direction of inflation. And you know, there are some numbers that are coming out which are really not true, but they really affect the perception of how people see inflation. And that, of course, affects behavior. It affects very different things. So the inflation risk that I see is really the stickiness. This is the thing that, and I think the ECB worries about that, how much is inflation going to stick? Because any reversal of policy direction will have to take a view on the stickiness. If it's not sticky, then of course we can let things work out. But if it is sticky, then the ECB will have to address it very, very differently. And here, that adds to a problem that has been, in my view, an important problem in the macro situation, and that is the awkward policy mix that we have. During the pandemic, you had the engines of macro policy stabilization moving in the same direction, the fiscal authorities helping everybody, but also the ECB helping everybody through providing liquidity, through monetary policy actions. In the energy crisis, these engines are now moving in opposite direction. You had the fiscal policy doing, so pressing on the accelerator, again, to help consumers, firms, but the ECB fighting inflation is moving in the opposite direction. And now you have an awkward policy mix. And we don't know how long this is going to last. And we also don't know how this is going to play out. So the fact that I think what Martin said is correct about the resilience, but it is a compound also effects partially. It is not a good situation to be in a position where the two big macro players, the fiscal and the monetary, are not working in the same direction. I think this is very awkward. So the question is, how can this stop? I mean, and when can it stop? So I think that is the second risk I would point out. And then I can't resist saying something about the fiscal rules. I think Martin described the issues very appropriately. I think the one risk I see here is that in 2014, some kind of rules will have to kick back. And those rules will effectively tie the hands of fiscal players coming at the time of recession or almost recession. So we are, constraining the fiscal instrument at times that actually we might need it. Now, this isn't necessarily without good reason. Fiscal policy has been used extensively. We have had what Martin called the lack of fiscal space. We have debts that have been severely increasing as a result of the two crises. But it remains a risk, the fact that you're bringing back a governance framework at a time when the economies actually might be needing a little more help. It's bad optics, but it could actually mean for bad macro policy. Now, it all depends, of course, on how the mix plays out. But these are the three main risks I will see for the immediate future. And then, of course, there are many more that are structural and they go beyond the term of your question.
Yeah, thank you. Again, a lot that we could pick up on, and we will pick up on some of this, particularly this awkward policy mix. I'll try to come back to you with a question soon about that. But before, I would like to now move to the more political side of this conversation. Siegfried, you are a senior, seasoned parliamentarian. You have a long experience in economic policy making. We have elections next year. 2024 is an election year. Of course, economic results will have an impact on this election. We know that when in times of economic difficulties and downturn, middle classes suffer and they tend to vote for protest reasons, often for parties that are liberal and not necessarily particularly Europeanist. So I guess my question to you is, how do you see the growth prospect, and also in your capacity as responsible for next year's budget, how can the EU budget help tackle some of the issues that have been put on the table?
Mm-hmm. Look, the truth is that whenever Europe is hit by a crisis, people in Europe expect the institutions of the European Union to provide support. We have seen that over the course of the economic financial crisis, 2008, 2010, but also in subsequent crises which maybe did not have an economic origin: migration, refugee crisis, Brexit, COVID, Russian invasion into Ukraine. None of these, by the way, caused by the European Union, but citizens in Europe expecting the European Union to support. And I think in each of the crises we managed to do a lot. We also managed to equip the European Union with some new tools, some new instruments to make sure that it can help and that it can improve the resilience and prevent, a next crisis to hit equally strong. Now, on the economy and in recent years, the truth is that since the last European election, since 2019, through the so-called European Green Deal, we have embarked on a fundamental structural change of our economy. I mean, it is a new objective which requires hundreds of billions of investments every year that the European public money level obviously cannot shoulder alone. We have ambitious targets. We all want to pollute less, to tackle climate change better, to be more energy efficient, and to accelerate the transition to a green economy. We have to make sure, to answer the political part of your question, that of course no one is left behind, that those categories of people and those categories of enterprises that have to shoulder some of the economic costs and that have to shoulder the bigger part of the burden are supported properly. So we have embarked on a fundamental economic transformation. We at the European level have said when it comes to the budget of the European Union, it can be part of the solution, and we have made the commitment that 30% of everything that the European Union will be spending from its budget and from the newly created recovery and resilience facility created after COVID will go into greening. This is a lot. With, of course, the budget being about 1,000 billion euros over the course of 7 years, and that recovery resilience facility being about 700 billion euros over the course of 6 years. So that brings in several hundreds of billions of euros of European investment into greening. But that, of course, will not be enough. Accompanying investments, public investments at national, regional, local level will be needed. And of course, through everything that we do, we are looking to incentivize private investments, which are key into those same areas. So we have embarked on that fundamental transformation immediately after 2019. Then in 2020, COVID hit with all of its economic and social components. And then we created what was, up to that moment, at European level, the biggest package of economic support, recovery and resilience facility, with the objective of helping people, enterprises, regions affected by COVID and the economic social consequences of the pandemic, but also with the objective to improve our resilience, to make sure that never again in the future a crisis finds us equally unprepared as this one had. Improve the competitiveness of the economy, improve the resilience of public systems, make sure that there are no bottlenecks in the healthcare system, make sure that education systems are relevant and particularly they are digitized enough. Significant investments there as well. Very often when there is money in the game, people talk only about the money, but the truth is that the Recovery and Resilience Facility is a program for investments and reforms. And it is maybe the first and most effective tool that existed at European level to incentivize, to inform much needed reforms at national level. Reforms which we have been talking about for the last 10-15 years. Some reforms happened, particularly in times of crisis, but not so much in between crises. So we do have now an instrument to incentivize reforms where member states where governments in each member states have to commit to undergo certain reforms to have access to that new fund. So I think it is very important that we continue on this course, that even in good economic times we reform, we consolidate our budgets, and we do not allow for vulnerabilities to grow, because what doesn't kill you in good economic times can completely, tie your hands during times of crisis. Too high level of debt, brings you as a government in a situation of not being able to support in times of crisis those who need to be supported if you did not save enough in good economic times. So to conclude and to finally answer your question, look, I think we need to keep course. We need to keep course. We need to continue reforming. We need to make sure that public money is well spent. We need to make sure that we create the right framework for the private sector. We create the right framework for the private sector to to invest in greening, in making our economy more digital, and of course, we are in competition with other parts of the world, particularly United States, doing a lot. Inflation Reduction Act, creating big incentives for investments in the United States. We're seeing that generating significant investments. Though I believe that our recovery and resilience facility is better at incentivizing reforms. So maybe we are a bit slower in making money available, but it is, I think, more sustainable in incentivizing reforms. And I would advise us to use the tools that we have before, creating new ones. You asked me specifically about the budget of the European Union. Look, this is 1% of the GDP. Budget is an essential tool that one has to transpose the policy vision into reality. The budget of the Union for a year is 1%. We have to be aware of what it can do and what it cannot do, though I believe that it has to give predictability. So as we are going to adopt the budget of the Union for next year, the main objective is to make sure that traditional priorities of the Union are properly funded, particularly as we're discussing also in the context of the Martin Center. I mean, making sure that rural areas are properly funded. The farmers had to adjust a lot in the transition to the green economy. Make sure that we do not burden farmers more is also something that is important to our center-right EPP political family. Make sure that we keep the convergence between the rural and urban areas. Make sure that we bring research, innovation, new technologies to villages, to rural areas as well, because I think we talk a lot about the urban areas in which innovation, research is concentrated, but we shouldn't forget the rural areas as well.
Yeah, thank you very much. I suggest that perhaps we start engaging a little bit with the audience, and I know that we had a Slido poll, and perhaps this is the moment to have a look at the result. Sandra, please, if you could tell us.
Indeed, Federico. As you remember, at the beginning of this panel, we asked our audience what is the most important economic issue at the moment, and the majority of you replied that it's lingering inflation, namely 53%. Another 23% said that it's looming recession, and the rest of 23% said it's high levels of public debt. Federico?
Thank you very much. I think that's interesting in a way. I mean, because it also corresponds to the results of a massive poll on the middle classes that we have done at the Martin Center, and the results that over half of the people have a very strong sense of financial insecurity and fear of falling behind. So, and that the cost of living crisis is the #1 concerns for most European citizens. It also corresponds, of course, to the findings of the Eurobarometer, the last few Eurobarometers. Anybody would like to comment on this, or no?
Maybe I can say maybe just a word. I think that it helps very much. It helps is not the right word, but I think that if the labor market was very different than what it is now, it is a very strong labor market. I think maybe the answer would have been a little bit different. If the risk of becoming unemployed was much more visible, I think that poll would have been different. So this is good news in the sense that we have a strong labor market. I think Martin also said that, which is absolutely very, very essential.
Yeah. So I would ask the audience if there are questions. You can start preparing for it and raise your hands, and we'll start giving you the floor. But meanwhile, maybe let's stay for a moment on the recovery and resilience facility. You were mentioning the new tools. Of course, that's maybe the most transformative, I would say, innovation in the EU's approach to macroeconomic transformation somehow in the last few years, because we shifted from a posture which traditionally was first you need to reform and reduce risks, and then we can have forms of joint investments. Now we are doing the opposite. Somehow we are putting the pot of money on the table, and we are trying to tie the reform process to that. You seem to be quite positive about the reforming results and of the RRF. So I would like to ask the other speakers, how do you see? I mean, we are about midway, I would say, in the disbursement of RRF funds and the spending of RRF funds. Is it really, I mean, such a successful tool for reforms so far, from what you can see from your observation point? Maybe we can start with Maria.
I would say yes. Of all the instruments that we put forward, I think this is the most interesting one in my view, precisely because of this point, because it does have the carrot for reform, which is absolutely essential. It's not easy to answer your question right now. I think we need to wait and see what kind of, if you like, actually outcomes we will have. So I don't want to prejudge that. But in terms of designing a tool, I think this has been a very successful one, and actually incentivizing countries to pass difficult reforms with, of course, the vigilant eye of the Commission, who is actually checking all of this. And you know, in terms of moving forward, I think it would be important to understand which features of the RRF are perhaps worth emulating.
Yeah, thank you. Anybody else would like to comment on? I know that that's a bit out of your purview, but perhaps Martin?
Maybe I can just echo points that Maria mentioned, namely that I think ex ante, this instrument, especially when it comes to its size, was a game changer. I mean, the instruments existed before. I mean, in the treaty, it's treaty-based, and incidentally, as some of you may know, this possibility was actually created in Article 122, linked to energy crisis. Right. So it was a sort of an irony of history, if you like, that one then sort of used this article specifically when then the crisis came, although it was launched, of course, before. I think the implementation is something that needs to be assessed then carefully once the program is over. What we know, I mean, we as European Fiscal Board, we do not specifically institutionally follow the implementation of the instrument month by month. But what we all hear is that in some countries implementation is faster than in others. Sometimes in the countries that would need it most, it's not particularly fast. But I think again, as I said, ex ante, this is of course something that helped very much in that particular context. Implementation is key now.
Thank you. I see we have a hand raised, two actually, so I suggest that we take perhaps Peter first.
Thank you very much. One of these white elephants in the room is the increase of EU's own revenues. That's not a topic we are going to discuss normally before elections, but this question will never go ahead. And I would like to have some ideas or some thoughts on the part of the panelists. What can these sources be? For the moment, they are very tiny, which are originally for the EU, but where the question will not go away, definitely. Thank you.
So maybe we can take this one. Of course, it's also linked to the RRF repayment, this issue of own resources. So maybe.
Look, I mean, of course, traditionally, the member states like to collect themselves taxes and to decide politically when and how much they allocate to the European Union. Traditionally, the European Parliament was always advocating for the European Union having own resources, own sources of revenues, so that the funding of the Union is more transparent, predictable, more objective, and not the result of political negotiations every 7th year. So this is what the Parliament stands for. Also, you know, we ourselves as the EPP. Now, there is a commitment at the level of the Council, the Commission, and the Parliament to do some work in this area, but of course we see that this is, for the reasons that I mentioned, more difficult at the level of the Council. If one were to announce that they tax, you know, the people of Europe more, that is something impossible, and that is also not the scope of this. So firstly, I believe it's very important to explain this properly, to make clear that it shall not lead to higher taxation for the people, for companies, to higher burdens. It is about making the funding of the Union more transparent, more objective, so that also people cannot so easily fall victims to the populism that exists right now in saying Europe is so costly, it's so untransparent, your country is paying in more than it is benefiting, and so on. So per se, I believe the idea is important, it is needed, And it is even more needed because of the creation of Next Generation EU, because Next Generation EU, the Recovery Resilience Facility, is about half grants, half loans. The loans, the repayment of the loans is clear. The Commission borrows the money on the markets, puts at the disposal of governments, they invest, and then the governments repay the Commission so that the Commission pays back the initial investor. But for the grants, we have to be honest, the repayment is not yet clarified. And either the governments pay back those grants by themselves, which they won't, for them it's subsidies, it's grants, or the budget of the European Union repays this between 2028 and 2058, which shouldn't happen. The budget of the Union is a budget for investments. It's not a budget for repayment of debt, and it would mean a significant reduction of the budget for all of the priorities, for all of the areas, be it agriculture, investments in infrastructure, research, innovation, Erasmus scholarships. So we would need to tell to all these types of beneficiaries, you will receive less because we have to pay back the markets, and we shouldn't do that. Or we introduce the own resources, which I believe is, the transparent and initially also the desired version. So far, there was a tax on single-use plastic that was successfully introduced, where the revenues, I think, are higher than they were initially predicted, and which also leads to the contribution of member states to the budget of the Union being reduced, because this year the revenues which the Union collects automatically from customs duties, single-use plastic tax, and that VAT-based contribution are bigger than initially projected, also due to inflation, because the amounts collected from the VAT-based tax because of inflation have grown. So the Union collects more from those automatic sources of revenues, so member states have to pay in less than what was initially foreseen. And by the way, that is 22% less than the member states have to pay into the budget than was initially foreseen. And that is a significant amount. I think that needs to be said publicly as well.
Thank you very much. Do we have another question there? Yeah.
Thank you. Adam Bartha from the Epicenter Network. I would like to bring a bit more ambition into the conversation than what the title implies with recovery. Our member think tank from Denmark published a paper today that calls for a regulatory budget that would increase GDP growth to 14% over 10 years. At the moment, it seems like we are very unambitious with our economic growth, with creating more prosperity in EU institutions. We're trying to redivide the already existing pie. And I would be interested in your opinions, what you think EU institutions can and should adopt in order to have at least a 3% consistent growth in the Eurozone and possibly even higher outside of the Eurozone. Thank you.
Well, that's a big question. So maybe we start from Maria.
I do not miss an opportunity to emphasize that what we actually need to do make urgent progress on in Europe is the Capital Markets Union. This is where I think the big levers are, because the 70 billion that we need, 600 billion that we need for the green growth, net additional investments over and above what we do now per year till 2050 to meet our green objectives will not happen by the taxpayer. And indeed shouldn't happen by the taxpayer. You need to find ways, we need to find ways of levering private money. And I worry that we are very much behind on stimulating capital markets to pick up some of the bill. In my opinion, without the capital markets, we would not be able to meet our investment needs. And that is the one, if I was to pick one, I would pick that as an urgent policy recommendation that needs to happen very, very, very soon.
Oscar, what would be your one pick to get back to 3% growth?
Well, in my case, perhaps the answer is a little bit easier, no? Because I come from an institution that has only one mandate, which is to preserve price stability. No? So I think this is the best service we can provide to the European economy and to the euro area citizens. And well, people do not like inflation, as you just saw in the reply to your question, for good reasons. No? Because I mean, employment, growth, and prosperity cannot flourish in an environment in which inflation is high, persistently high, and unpredictable. No? But I would say a couple of things more. No? Of course, I would agree with you that making tangible progress in the capital market unions is absolutely a priority. But also we have to complete the banking union, which is, if not more important, at least equally important, no? Given that most of the financing to our productive sector goes through the banking sector in the EU. And there are some still there are some important elements which are missing in the banking union, no? Including a common deposit guarantee. No? So there are some fronts in which progress is absolutely essential. Another one, you mentioned it before, is we need to conclude as soon as possible the discussion on the governance of fiscal policy in the European Union. We have to kill this source of macroeconomic uncertainty at a time at which we need to bring more macroeconomic uncertainty. And of course, we have to be very ambitious with structural reforms, avoiding any kind of complacency. The challenges that we are facing are very, very significant. They are probably more challenging and more demanding than when many of the reforms were designed in the context of the Next Generation EU. We are facing new challenges. And perhaps we should keep ambition as high as possible. I'm more familiar with the area that Martin mentioned in terms of the implementation of the expenditure in Next Generation EU. And as you mentioned, I mean, I think it's pretty clear that in some cases we are lagging behind the schedule. And in terms of the structural reforms, I would agree with you. I mean, it's equally important, maybe more important in some cases than spending money, because you need to raise potential growth, which has probably been damaged in the European Union, in the Euro area, after two important crises, the pandemic, but now the energy crisis. So we have to be very, very ambitious on that front, because long-term prosperity is likely to come more from structural reforms than from just current expenditure.
Thank you very much. Would you like to add anything on the 3% growth issue? But also maybe another aspect, of course, I mean, this is long term. I mean, what we need to do at the structural level to get back to higher growth. Maybe you can say a word also on the fiscal stance, because short term, I think the fiscal stance that we have will have an impact on developments next year, for example. What should be the fiscal stance, and any additional idea on structural issues?
Okay, yeah, so following your lead, I will start with the long term and then come to the short term. So let me say that I very much agree with what Maria and Oscar just said. So I remember that at the end of 2019, I read a survey among leading economists in Europe about the top priority for the economy in Europe. So this was before the pandemic hit us. So it was clearly the capital market union and the banking market union. I think this sober judgment, this sober conclusion still holds. It's just that in the meantime, we had to deal with other very urgent things like fighting a pandemic, fighting an energy crisis, and new challenges. So I think if we want to get to higher growth, then we need to tackle these important projects. Then there is also the issue that was mentioned before by the MEP in relation to the question on resources. The more general question is, where do we want to intervene in a federal system, in a general sense? Now, not as an ambition, but in a general sense. Do we want to intervene at a national level? Do we want to intervene at a European level? So I fully agree that it would be bad to communicate, that this costs much more and Europe costs us more in terms of taxes. I think the underlying question is, where do we need to intervene? Where is the scope, where the economies of scale for intervention at the European level? And there's, I think, a growing understanding that certain things are best dealt with at the European level. That does not mean that overall we have to pay more taxes. It just means that we have to think hard about where it is best to intervene. Defense is now an obvious and very current topic, but there are others. And then let me just echo Maria and Oscar on the importance of structural reforms. I think, again, the pandemic and then the energy crisis, they have, let's say, attracted our attention for good reasons on these two major challenges. But again, I think the understanding that we need structural reforms in some member states, maybe more than in others, is very clear. And that is maybe one of the main avenues towards, well, I don't know, 3% growth, but certainly higher growth, because, and here I come back then to fiscal policy, if we have a problem of, say, concerns about public finances in some member states, then on the first, let's say, the most important and most evident problem is that there's a shortfall between revenues and expenditure over an extended period of time. That goes up, but in some countries this is because growth rates, economic growth rates, are very low. So we need to also launch again the structural reform agenda. As I said, it was difficult during the last 2 or 3 years because of other very pressing challenges, but this is key. Also for to tackle public finance issues in some member states. And again, I know that in the public debate one has to come up with short statements and so on. And I can say this because I work for Fiscal Watchdog, so you will bear with me. But it is also important to recall that we don't have a general public finance problem in Europe. It's not that debt levels are high in all member states. It is not true that there is no fiscal space in the member states. We have some member states, as I said at the beginning, where let's say public finances followed a course that you expect from a macroeconomic point of view, and in others you had a different course of action. But if you then come to then what does it mean for the short term, I think I can just maybe elaborate on a point that was already raised before, namely the policy mix. We mentioned the fact that the energy crisis was in terms of a trade shock, so it hit us all. And let's say among macroeconomists, the best way to illustrate what it means is that the economy as a whole makes a transfer to the energy producers. So we as a whole, as an economy as a whole, we become poorer. You cannot stabilize this. From a political point of view, and I have the most sympathy for that, I understand that one then says, yes, we have to sort of help the most vulnerable. But if you look at what most member states have done, they have essentially implemented untargeted fiscal measures. There's, by the way, a very nice paper by staff of the ECB that is coming out soon and shows that, yes, in many member states, the fiscal measures have increased the incomes of low-income households, but they have looked at how the effect has worked out across the various deciles of the income distribution, and in most cases that were studied in this research, so that at the end, and in real terms, the higher income deciles actually got more out of these measures. So I think when it comes to the policy mix, I think there's a scope for improvement overall, leaving aside the question whether some member states have a sort of a sustainability issue or not. And just let me just conclude with one possible comment on what Maria said before, namely that it may not be a very good idea to bring back rules next year when the economy is still expected to be weak. I think to equate the application of fiscal rules with austerity is wrong, with due respect. Fiscal rules have never been implemented as an instrument to impose austerity. They've always been meant to keep public finances on a sustainable footing. That is actually the statutory objective of the rules. And in fact, we as Fiscal Board, we have tried to always underscore that, for instance, also procedures that are sometimes perceived as having a stigma, like the excessive deficit procedure, are not meant to immediately push a country into austerity. No, it's a medium-term plan that is meant to communicate and to anchor expectations for the economy as a whole, including financial markets.
The point is clear. Thank you very much.
Thank you.
I hope you have the chance to reply. We have time probably for one more question, and I see that there is a gentleman here.
The European economy doesn't function in a vacuum, so I'm wondering from the panelists, if you look beyond the borders of Europe, where do you see the greatest risks to the European economy? Is it a recession in China? Is it a prolongation of the war in Ukraine? Is it a change of leadership in Washington? Where do you see the vulnerabilities outside of Europe?
Let's take this other one as well. I see another hand up, and then.
Hi, thank you. I fully agree what was said so far, what we need to get growth to Europe, but most of the things we're looking inside. The EU is an open economy, and I think what companies need in Europe is to be competitive in the global economy. So looking at that, to competitiveness, what is the role of a proper regulatory framework and the single market, which by now it turns 30 years. What reforms should be done to the single market to achieve that?
Okay, so I would suggest that we proceed in the following way. The single market question, I have the feeling that you are probably the best positioned, Siegfried and Maria, to answer that. And then we take a last round, full round, on the greatest risk. And I think that's a good question to end on. What is it that policymakers should watch in the next month and the next year or so? What is the greatest risk they should keep in mind? So I suggest that we start maybe from Siegfried.
Yeah, so I mean the question was related, Gonzalo, thank you, to the single market and competitiveness. And in the Conference on the Future of Europe, we have together agreed that competitiveness is essential to safeguard the high social standards in Europe. If you talk to citizens, you ask them, how do you expect Europe to be? What do you expect from Europe? They would always tell you higher social benefits, higher salaries, higher pensions, higher minimum salaries. None of them will tell you that I expect fiscal consolidation or I expect competitiveness, but these are needed to safeguard the high security standards that we have here in Europe. And we have managed to anchor in the Conference on the Future of Europe the idea that the European Commission in the future, whenever it puts legislation forward, it should do a so-called competitiveness check, basically to make sure that whenever legislation is being put forward, it does not negatively affect the competitiveness of the EU economy. And so, of course, your question is broad on the single market and on competitiveness, but I believe that the first step that we have to do as policymakers is to make sure that whenever we put legislation forward, we make sure that ideally it does not negatively affect the competitiveness of our economy. So if it does, and if it does, it should be, you know, as limited as possible. I believe that's important as a first step.
Thank you. Maria, feel free also to react to Martin's point if you want.
Yeah, well, maybe just first on this, I think it's absolutely essential that we maintain the high standards of Europe. The question is how to do that. I think if we resort to protectionism, this is very tempting. This is going to sincerely damage our competitiveness. And I think in the context of a world, and it pertains also to the question of the risks, there is a very big risk of isolating ourselves because the world is running in this direction. But if we deglobalize in a way that actually brings back higher costs, so this is going to be very detrimental to our economies. On Martin's, of course, the way that Martin phrased it is absolutely correct. But I think timing is matters. It would have been a lot easier if we were at the breadth of the tip of growth and then introduce what effectively would be greater restrictions on the way we use fiscal policy. But of course, he's right. It is about the long term. It is about discipline. Just that.
Very, very shortly, the greatest risk, very like 30 seconds each, starting from Martin and ending with Siegfried.
Right. I will stick to, let's say, my area for fiscal policy. I have no particular view on external risks, but from my perspective, the risk is that we are hit by another big, possibly external shock, and then there is not enough room, for instance, in the fiscal area in some countries to react to it.
Thank
so
you.
that's a risk.
Oscar?
Well, we are the most open economy out of the largest economies in the world, much more than China, but also especially than the US. So what happens outside is very critical for us. In my view, the main risk outside is still the one coming from the unjustified war of aggression of Russia on Ukraine. And what happened over the weekend is probably telling us something about the remaining capacity of causing economic damage by some actors around on the euro area economy. Of course, China is an element of concern, but I think that in terms of a genuine economic risk, we are still particularly worried about what's going on in the Russia sphere.
Clear. Thank you very much. Maria?
Yeah, I totally agree with Oscar. Actually, I think for us that war is an existential risk, so it has to be up there as the greatest priority. To that, perhaps I'd add the issue of global fragmentation. I think that is something that is becoming extremely prominent, and it comes from all directions. It's difficult to choose which direction it's coming from. Fragmentation.
Thank you. Siegfried?
Look, obviously, I think we have to reduce the energy dependence on Russian fossil fuels up to zero, make it irreversible as soon as possible, and learn from that high dependence that we had, that never again in the future we should be dependent on any single source of energy, any single country of origin, or any single route of transport as we were on Russian fossil fuels. De-risk from, including de-risk from China when it comes to new resources. And then, of course, up to Saturday, we had to live with the war. I totally agree with what Maria Oscar was saying on the importance of that one, the risks for our economy. Now it's 2 wars. The consequence of that will be that we will have to invest more in security defense. We will have to do it quicker than we anticipated and for a longer period of time. And I believe that that will have an impact upon our economic model, because whenever we spend, we also need to find some ways to how to finance that. But I think it will be important, and I think it will be something that people will expect us to deliver in the next months: security, safety.
Thank you, and that's a good issue to end on. You all agree that it's an external shock that we have to fear, and indeed the security and defense aspect that we have discussed extensively also in previous panels must be emphasized. Well, thank you very much for this fascinating conversation. Thanks for everyone for your participation, and it is now the moment to hand over to Sandra.